What is going on, investors? Hopefully you guys are doing well out there. It is Friday, and it's time for the FAANG Stock Recap Show here on the Investor Channel, where every Friday we cap all the major news and the technical chart patterns from all the major FAANG stocks. This week, we've got a lot of news. We had an all-hands-on-deck meeting over at Tesla. Talk about what they talked about there. We've got the TikTok ban approaching here in the United States. Talk about some movement there. Amazon is planning some higher-end devices. Apple is making a lot of news as well. Better get to all of that and kick things off like we always do with Meta Platforms. Start of the week, it's 611. Shares of the social media giant down about 2.5% to finish the week at 595. Year to date, shares are still higher by about 1.8%. Talked about that TikTok ban, which is approaching for the United States business. It appears that Oracle is at the center of this, as the company has been handling the company's data from its United States customers in data centers located here in the United States. There is still confusion over whether or not ByteDance, the parent company, and the Chinese-based company will have control over the algorithm, be able to view users' profiles, be able to view any of the data, or if all of this will be completely separate. Also, ByteDance, the Chinese company, wants to maintain maybe a small stake in this, continue to share in the profits. That also remains a question mark. Who will be the companies, aside from Oracle, that will take a stake in the United States business? All of this remains still a mystery. My guess is some of the other companies that we talk about, particularly Microsoft, will likely want to come to the table here. This will become a much bigger story as we move forward. We'll see how this impacts the competition as it relates to Meta. My guess is the company is probably not going to be allowed to be a part of that investment, but who knows? All things being considered, it looks like a deal will be made here. It's still a little confusing, and probably not all the details are known to us as investors, but it definitely appears that Oracle will be at the center of this, which makes that company in particular a very interesting investment. Moving on to Apple, start of the week at 214. Shares moved higher by 1.7%. Finished the week at 218. Year to date, though, the iPhone maker has seen its shares fall by about 13%. Apple executives held a meeting, and they came to the conclusion that they need to shuffle some of the executives that are in charge of particularly Siri. As we reported last week, the company is delaying, or maybe it's a week or so ago, the company is delaying a new advancement in Siri, which they showed off last year at the Worldwide Developer Conference held by Apple every year. In fact, they've even showed off some of that Siri advancements in some advertisements as well, and that feature just simply is not available on any phones. We also saw this as it relates to Amazon and Alexa. They've been showing that off, but they also haven't been able to come to the table with their next generation there. It obviously is very difficult. What I saw, at least under the hood here, is they're having difficulty combining the old Siri with the new Siri, and the fact that the two need, in some cases, to be able to communicate. They haven't been able to solve that from a software perspective. It's much easier to build these things kind of from the ground up, so to speak. A change in executive here may be a good sign, but until you actually ship a product over at Apple, remains to be seen if they're able to deliver. Now, also news crossed with Apple as it relates to their TV Plus programming. That has nearly 45 million subscribers. The subscriber numbers around Apple TV Plus probably slightly muddled in the fact that they do give you free access, or they give you a subscription, I believe, for a while if you buy certain types of Apple devices. And so some people might be subscribers to Apple TV, but maybe don't even use it or don't even notice it. But what was noticed and reported was the business unit is losing about $1 billion annually. We'll talk about this when we go over to the Netflix segment. Is after kind of the top two, YouTube and Netflix, it's very fragmented among maybe a dozen providers. So it'll be interesting to see in the streaming space, because you have competitors like Apple that are losing money. There's others in the space. Disney Plus has been long rumored, or actually long reported, that they haven't really made a lot of money there. Roku just marginally profitable, I believe, as well. So it'll be interesting. Do you have consolidation here? The fact that they're losing $1 billion annually, does it mean they continue to invest, try to grab market share, or do they go out and try to grab competition to consolidate the market? And that's how you generate profits. Be interesting to see. I'm not exactly sure the answer there. Now, company is planning to use liquid metal hinges for its foldable iPhone. This is projected to come out maybe potentially in 2026, costs more than $2,000. I think this will be an interesting product for Apple, certainly from an innovation standpoint. If they are able to pull this off, could see some inroads in China with a device like this. And that is because we're seeing foreign phone shipments in the great country of China slumping 21% in January, according to reports, as domestic providers in China continue to outpace the overall market. We're seeing this in EVs. We're seeing this in smartphones. Nike's conference call even indicated that in Nike's case, you're seeing some competition as it relates to their Starbucks. Anybody doing business in China, it's really interesting. There's been this shift in China where in the past, the consumer there has always looked a little bit different than an American consumer, but they tended to place a premium on American brands. That's why if an American brand got access to the Chinese market, it would blow up. It would be great for their business. Seems to be a shift in China more recently, more back to domestic Chinese-based brands. Some of it has to do with subsidies that the Chinese government has kind of put in place. Maybe it's something culturally. I don't know. If you're an expert in China, I'm not talking about somebody that just reads about China, but you've been over there. You're from there. You know the market very intimately, or you know somebody that does. I would actually love to interview. It could be a public interview. It could be a private interview for these types of things. But I'm actually looking for answers to some of these questions. And if anybody knows anybody like that, you can leave me a comment down below and I'll give you a way to reach out to me. Moving on to Amazon, start of the week at $198. Shares of the e-com giant down about 1.2%, and year to date have slipped down by about 11%. Anthropic, which has an investment from Amazon, they are rolling out web search and they're joining a growing list of basically AI search engines. And I'm just seeing this, you probably are seeing this yourself as well, is some of your search traffic is shifting to these. Maybe you have Gemini downloaded as a standalone app. Maybe you have Grok. Maybe you have Anthropic. Maybe you have OpenAI. My guess is some kind of thought comes into your mind, and instead of using Google, you're using the AI. It happened to me last week. I was in San Francisco with my kids. We were at like a science museum, and they would ask me questions that I just didn't, I just don't know. I'm not a science guy, okay? So I don't know the answer to this question. You know, it's like, why is the universe doing this? Well, let me ask AI. In the past, I would have put that into Google and tried to come up with an answer. Now I can put it into AI and have a great answer, maybe even some visuals to show my kids. And so, like, I actually think this is interesting. We'll see as we get to Google if it's impacting their business. Will it impact their business? I think it will, but can Google capture a lot of this search traffic coming for AI solutions? There's going to be a lot of competitors there, so the business model is going to look different. The U.S. executive responsible for generative AI is rumored to leave, or actually did leave the company. This, I think, is probably a broader restructure of Amazon. I saw this on other news sites this week as Andy Jassy is basically eliminating kind of the middle management of the company. We're seeing this across a lot of business. This is kind of a business trend more recently that I've seen, is that you're trying to flatten out the organization. You're trying to have a chief executive, chief financial executives, basically the C-suite. And then underneath that, in MBA school, in traditional business, what you wanted to have another layer of management, and then maybe another slightly lower level of management underneath that, and then you have kind of a broader range of employees. What you're seeing across business now is a flattening of the organizational structure where you have the C-suite executives at top, then maybe a very thin layer of management underneath that, and then you've got everybody just doing the task underneath that. Or in the case of other companies, like I was looking into Chipotle the other day, they have somebody just in charge of like the locations, you know, like somebody that's just launching stores, make sure they're running efficiently. In the past, that might have been like a middle manager underneath another executives. Now that is like an executive role. And so Amazon has been doing that more recently. They've been trying to eliminate this middle layer of executives. And I think that's probably the case here. It's not really that AWS is not a promising opportunity. It's that they were trying to get rid of some of the management in the middle. When I was at CES back in January, one of the booths I spent a fair amount of time in was Amazon. And I think I did a video on this, like a short form video as well, is at the time they were just partnered with Kia, and it's still the case. You can go on Amazon right now and buy like a Kia if you wanted to. And they were showing this off very prominently at CES. And when I was talking to the guy, it's what's interesting about these conferences is you can go there and the people in the booths are not trained on like what they can say. Like they'll basically tell you everything that they know. And what's interesting, I was like, oh, just Kia's doing this. I was like, is there anybody, like, is Amazon going to expand this? Are they going to go to other? And he was like, oh yeah, we're going to go and launch used cars, and other new car brands are already in the works. And here we are a couple of months later, and it looks like you're going to have used cars coming to Amazon. And my guess is a lot of brands will use Amazon's platform at least as one outlet to try to sell the cars. Now, Zoox, which is the Waymo or Tesla Cybercab or whatever you want, Robotaxi version of Amazon's autonomous vehicle business, is very close to a commercial Robotaxi operation, I believe out here in San Francisco. Now, Amazon's approach with Zoox is a little bit different. There are these cab-like vehicles, almost like mini buses, and I brought up a picture for you here. This is basically what you're kind of working with. It's these things that are, I don't know where this is going to fit in the market. I think they're trying to sell something here that is not as big of a market here in the United States. They want you to get in these things and face each other and talk to each other and stuff like that. So I think they're trying to sell a dream that actually doesn't exist here in the United States. Most of the time when you get in these vehicles, you really just want to sit there and just be on your phone or answer emails or something like that. But this type of form factor will have its role in the autonomous vehicle rollout. And I think one of the mistakes that I'm seeing a lot of investors as I report on this and I talk about this, everybody's thinking about Tesla. Everybody's thinking about Elon Musk because that's who they pay attention to. That's who has one of the largest voices for a number of different reasons outside of he owns one of the largest social media sites in the world. But when we're talking about autonomous vehicles, we are talking about Google's Waymo, which I believe Google owns about 60 to 70% of that company. So you're basically talking about Google, and we'll have information as it relates to Waymo here in a moment, how they're rolling out to larger areas of the Bay Area. We're also talking about Amazon, which owns this Zoox company. So we're talking about Google. We're talking about Amazon. We're also talking about Tesla as well. These are three companies that are extraordinarily well capitalized, have extraordinary marketing, have extraordinary users base. When we're talking about Amazon and Google, we're talking about companies that have access to basically every major consumer here in the United States. So this is how you have to think about the autonomous vehicle market going forward. That it's not just Elon Musk, that it's not just these startups that don't do anything or have no customers or no access to them. We're talking about the most well-capitalized customers. So you have to think about that when you start thinking about the competition that is emerging here. Amazon is planning to offer discounts for access to its own server chips powered by its own Trainium chips. This is its own custom silicon chips. I saw some people saying, oh, well, the AI market's already become a commodity and that they're actually, they're offering discounts. This not really true here. Understand that to run an application in an AI environment, you not only need the custom silicon, or the silicon in this case, doesn't really matter if it's custom or it's not, but you need access to the hardware. But there's also software that runs on top of that. You can't just make a chip and then run any type of software on that. Nvidia's business model, and most of you are very well familiar with this, Nvidia's moat around their business is not just on the hardware side, it's also on the software side, and that developers that you have to hire in order to run applications on these AI chips, they have gone to school, they have gotten training. And what have they gotten training on? They've gotten training on NVIDIA software stack. And so the fact that Amazon has to offer discounts for its own chips, it's not really saying anything about NVIDIA, other than the fact that their software is probably so good in order to get you to want to use the Trainium chip. It can't be the same price as an NVIDIA GPU because the software probably takes a more specialized person. I have to find a software engineer that can write software for the Amazon chip. And in order to find them, I might actually have to pay a little bit more. And that might be why I have to have a discount to access the hardware, because the software engineer is even more expensive. Big time interesting story here that under an executive over at Amazon, they are working on higher end devices for Alexa as they continue to want to roll out a higher end version. Very interesting quote here. He said, "I want perfection in every single product we ship, period." Very Steve Jobs-like, I would say. "There won't be a corner cut. It won't matter if we tried it before." That was a very interesting sentence. And it said, it won't matter what you thought it used to be. And so what he's saying here is, look, Amazon has done things in the past. They've had tablets, they've had phones, they have some devices that are still relatively popular. I think this is probably a prelude to that they're going to get back into those markets, that they are going to release devices, maybe a phone, maybe tablet, maybe they even get into like personal computer, Chromebook, desktop type stuff. They're going to get back into those markets. That's what I read from that. Moving on to Netflix. Start of the week at 9:52. You're going to want to see Netflix technically, because it's my belief, and you can kind of look at the Netflix technical chart. It actually leads the way technically for most of these other stocks. So if Netflix turns lower, it probably means in a lot of cases, technically, that the rest of these stocks will come with it. And we saw that with Netflix. And if it turns higher and resumes trend, the rest of these will follow. And we're kind of seeing that with Netflix. I'll show that to you technically. Now, one of the things that I talked about on the Apple side is that outside of YouTube and Netflix, which have 11.6 and 8.2% of the streaming market, after that, you kind of have very low single-digit kind of demand for the other streaming players. Now, some companies like Amazon and certainly Apple as well, they can afford to run at massive losses because they have these other massive businesses. Where the question mark remains is companies like HBO Max, Paramount, Peacock, Tubi, Roku, Pluto, shoot, even Disney. Disney stock has been a disaster over the past maybe even decade to own. Where do these companies stand? And that is why I think you'll have consolidation, not necessarily this year, not necessarily next year, but at some point, this has to consolidate. Amazon's got to come in here and buy some of these competitors. Apple, if they want more market share, has to come in here and buy. Netflix would probably love to come in here and buy some of this up as well. Will they be allowed to do that from a regulatory standpoint? When we get to Google, that will be tested, but we'll see what happens there. Moving on to Nvidia. Start of the week at 122, and during GTC, Nvidia shares slipped by about 3.7% year to date. They're off by about 12%. The humanoid robot evolution or revolution is upon us. That's according to the Nvidia CEO. He has basically been pumping this for about 6 months now. He's trying to change the tone and the tenor of a lot of his keynotes, or at least the parts of his keynotes that, and I'm talking about Jensen Huang here, the parts of his keynotes that get a lot of attention are now focused on the humanoid robot. We'll talk about this more when we get to Tesla, but this obviously, as you know, I think is going to be like a multi-trillion-dollar opportunity over the next couple of years. Nvidia is said to invest hundreds of billions of dollars in US-made chips and electronics. I think they were probably going to invest a lot anyways. You have the Taiwan Semiconductor investing heavily in Arizona, and we've reported on it numerous times that they're already making kind of the high-end leading-edge chips as it relates to Apple, and they've been testing, I believe, Nvidia as well. The thing is you still make the chip here in the United States, but it has to be packaged. It has to be sent back to Taiwan or another Asian country to be packaged and put into a device. And so we're not even close to being independent. I don't even think this is something that is even possible. You are not going to, at least in the short term, you are not going to be able to, for example, make the iPhone chip here in the United States and then go package and ship that over to Alabama or Arkansas or Texas or any of these other states and then go make the phone there. Now, the humanoid robot stage and the robotic stage that we're moving into, that could make that a reality. Instead of making these phones in China, you have robots make them here in the United States. We're still several years away from pulling that off. I think we're laying the foundation, maybe not even the foundation, but we've got the bulldozer and we're kind of flattening the land ready to lay the foundation. And so we'll see what happens. Obviously, from an investment standpoint, that is very exciting. Quantum stocks, this is the qubits and the others in that space. They headed lower as Nvidia hosted its first ever quantum day at GTC. What was interesting about this is a couple of months ago, you might recall that Nvidia's CEO, Jensen Huang, I believe this was at CES actually, was asked about quantum computing. And right off the cuff, Jensen Huang said something like, I don't think quantum computing is going to do anything interesting for the next 10 to 15 years. Not a direct quote, but that's kind of the gist of what he said. Quantum stocks at that time took a big leg lower on those comments. What's interesting is what was revealed later this week is Jensen Huang said, I didn't even know quantum computing stocks were actually public. So it just shows you how laser focused Jensen Huang is. He literally didn't know that IonQ, Rigetti, Qubit, among other companies, were actually public companies when he said that. So in one hand, you could say, well, Jensen Huang doesn't know the market very well. He must not know much about quantum computing. And I heard at least him on Jim Cramer this week, like there's probably a little bit of aspect to that he doesn't really understand quantum computing that much. And it's something that he's just kind of wrapping his head around. But there's actually truth in this because as I've researched quantum computing, this dates back to when I was working at MarketWise. They wanted me to run promos on all of these quantum stocks and they wanted to pump them and those types of things. And I was looking into them and I was like, these things are still 10 years away. It's still the case. And it's okay to be early as an investor in some cases, but as it relates to quantum, what these companies, and you're going to see this, and this is already kind of a reality, is they have to pump the stocks. And then when they pump the stocks, they have to do a fundraise. So they go and dilute you as a shareholder. So you could be right that Quantum, Qubit, or IonQ, one of these companies actually does relatively well in the long term. But over the course of many, many years, you might get diluted down to a very small percentage of the EPS that you actually get to benefit as a shareholder. And there's certainly no guarantee that any of these companies will be able to survive those 10 years, as the stock market is less about 10 years from now and more about 30 to 60 days from now. Now, obviously the best investors in the world can have a 10-year time horizon, but again, it's difficult as an investor when you don't have a lot of revenue coming in to support your business model over those 10 years. So Nvidia is responding by opening its own quantum computing research center in Boston. This is probably not great for any of the quantum computing stocks, the fact that Nvidia can get into this market. Nvidia acquired a synthetic data provider earlier this week. Synthetic data, just in a really small nutshell, is data for AI is collected by scraping the web. So they scrape sites like Seeking Alpha. They even scrape like YouTube videos like this one, and they pull that data in. Well, synthetic data is basically AI creating data. So you ask AI, hey, tell me about the dinosaurs. The response that the AI gives you is more or less synthetic data that is relying on previous data that was previously scraped from the internet or books or videos. That is a broad generalization. There's certainly nuance as you get into synthetic data. There is different versions of it and more sophisticated versions than what I described. But the fact that they're getting into the synthetic data is showing you that Nvidia is probably developing more and more of their own language models, and they'll be much, much more on the software side as it relates to just the hardware side. Now, CoreWeave, which I think has a 5%, maybe off the top of my head, I think Nvidia owns about 5% of CoreWeave. They're trying to go public. It's difficult in the volatile market, but they're seeking a $26 billion valuation as they had their revenue over the past year, I think, go up by like 700%. Moving on to Google, start of the week at 166, down about 1.3% over the past 5 days. Finished the week at 164 year to date. Shares of Google down about 13%. Got a ton of messages on this. The headline reads that Google is to turn to MediaTek for cheaper AI processors. Citing two people familiar with the matter, MediaTek could develop TPUs, which is primarily, at least when we're looking at the server side or the data center side of things, is primarily dominated over at Google by Broadcom. Many people that don't understand the semiconductor business will look at a headline like this and say, oh, well, Broadcom's cooked. They're getting replaced. They're getting designed out. It's not the case here. This is relatively old news. MediaTek tried to design something for Google, I believe, a year ago. It failed test. What Google is trying to do here is have some diversity, okay? They don't want to rely strictly on Broadcom. And as a Google shareholder, also a Broadcom shareholder, I don't want Google to just strictly rely on Broadcom. They shouldn't have just one provider, because if shit hits the fan over at Broadcom, they turn into Intel. Well, all of a sudden, Google's ship will sink along with that. So Google is being smart here and trying to push another company to develop some silicon that they can rely on, so they don't strictly rely on Broadcom. Also, it gives Google stronger negotiation powers when they go and negotiate with Google. This doesn't mean that Google is going to kick Broadcom to the curb and only focus on MediaTek. Absolutely not. What they are trying to do, and this is what sophisticated organizations do, and you as an individual shareholder, if you want to start becoming more sophisticated, you have to read headlines like this, and you have to analyze it from a business perspective. You're saying, oh, so Google wants to go to the table next time they're in pricing negotiations with Broadcom and be able to tell them, oh, we could order this amount from MediaTek. We could design this over at MediaTek. So what is Broadcom going to do? They're just going to sit back and watch all their business go away? No, chances are they're going to lower the price or provide Google better terms. That's what this is about. And if you're a shareholder of Google, you want them to have diversity as it relates to silicon. So they're not just relying on Broadcom. So they're not relying on just Nvidia or Intel or AMD or one of these companies. You're able to come to the table when you're in pricing negotiation and pin these companies against each other, and then you find out who wins. This is how a 1% investor thinks, rather than a 99% investor says, oh my God, MediaTek must be a great company. Broadcom must be going to shit. That is how a 99% investor thinks. 1% understands there's a lot more nuance to these types of things. Now, bearing the lead a little bit with Google is they made a $32 billion acquisition for a cybersecurity company. The way I've been looking into a lot of cybersecurity companies, and the way I'm describing them is it's like insurance, okay? Like, you hate to have insurance, but it's something you're always going to have. If you're a homeowner, you have insurance on your home. If you can get it in your state or whatever, or if you have a car, you have insurance. And so it's something that's always going to be there. And I think cybersecurity is one of those things in tech that you're always going to have. Like, there's always going to be backdoor ways into companies. There's always going to be ways to try to gain access to a database or a server or any of these types of things. And so just shoring that up over at Google, probably a good thing as it relates to this. Now, as it relates to this deal, obviously this is the first major test of the Trump administration, which is this belief by Wall Street. And I think it's actually a wrong belief that the Trump administration is going to have a rubber stamp as it relates to acquisitions, and Microsoft could go buy Salesforce and Meta could go buy TikTok or Snapchat, and just deregulation, rubber stamp, let these companies combine and get bigger. That is not going to be the case with big tech. This deal has a $3.2 billion termination fee, which is like 10% of the buy price. And we've seen these termination fees actually get paid out in the past. I was just looking into Adobe and I saw the $1 billion termination fee that they had to pay Figma on their financials. And so these things are real. I think in this case, as it relates to cybersecurity, there's enough players in cybersecurity. It's also a very fluid market. It's also one of these markets that, unless you're deep in the weeds of cybersecurity, it's hard to know, like, what makes Palo Alto Networks different than CrowdStrike or Zscaler or any of these other ones. Like, you actually don't really know. And so I don't think regulators working for the federal government are going to know. So my guess is this is probably going to go through for Google. This is less about competition, probably taking a partner that works well on Google Cloud and just rolling it up in there. Now, the company unveiled Pixel 9a, which is set to compete with the Apple iPhone 16e, which is the new lower priced Apple iPhone. I put that in quotes because the Apple iPhone 16e starts at $600, which is still pretty expensive. The 9A starts at $500. So what you're seeing here in the smartphone market is they're lowering the price. They're believing that, hey, if we lower the price, we're going to be able to capture more market share. And so maybe consumers aren't upgrading because some of it might be feature related, but some of it could be price related. These companies are showing you that it's probably more price related. And then if you release a decently good phone for $500 to $600, that people will buy it. We'll see if the data supports that in a quarter or two, but very interesting trends from that perspective. Now, more on the self-driving stuff is Waymo is making inroads in San Jose, which is a large city just outside of what we consider quote unquote San Francisco. You also get access to the San Francisco airport, which is a tremendous market because obviously if you're catching a flight, you're taking an Uber. Even if you have a car in San Francisco or just outside of San Francisco and you're trying to take a flight, instead of going to the San Francisco airport and parking your car, well, yeah, you're probably going to take an Uber there. And so the fact that they're likely to get access to this, now this isn't full access quite yet, but this is likely coming very, very quickly. Last week when I was in San Francisco, my sons and I sat at a pizza restaurant and it took a while for our food to come. It was delicious, but it took a while for our food to come, and we sat there and we were looking out the window, and you could tell my kids are like into what dad does. And I was like telling them about Waymo, and they wanted to sit there and count the number of Waymos that drove by. And so we put the over and under initially at 20, and because it took an hour for our food to come, we actually got over 50 Waymos. And so people that don't live in these large cities, they don't understand what is happening in the self-driving space. They don't understand what's happening in the autonomous vehicle space. They don't understand. Most people don't even understand that Google actually owns Waymo, or most of Waymo. They also don't understand that in just a year's time, that in the San Francisco market, Waymo has gone from basically not existing to now having a bigger piece of the market share than actually Lyft. And so inside of San Francisco, Waymo is only able to operate in a small area inside, and I say small, that's in air quotes, inside of just what is considered the city of San Francisco. If you were to get a ride there, you're either taking an Uber or you're doing Waymo. This is going to expand out into San Jose. Eventually, it's going to spread out to all of California. And so you're probably looking in a year or two from now, the entire California market will actually be dominated by companies like Google, like Amazon, eventually a company like Tesla as well. This is why I'm bearish on a stock like Uber. It's because these companies don't need them. Doesn't need Uber, doesn't need its customer list, doesn't need it for anything. And these types of things are coming very, very quickly. Moving on to Microsoft, start of the week at $389. Down, or actually up by about 0.5% year to date. Shares of Microsoft slipping by about 7%. Not a ton of news out of Microsoft, but you'll want to see that one technically. Moving on to Tesla. Shares start of the week at 243, and then I think the vice president candidate was saying it was 225 and dropping, and shares reversed all the way back up to 248 on Tesla, up about 2% this week. And year to date, though, down about 38%. You want to stretch this out to a year time frame. I mean, if you got no stomach for volatility, Tesla is certainly not the stock for you. It is an up and down ride. Company is turning promotional in China as it relates to their full self-driving trial. This is something not new. This is not even a sign whether or not full self-driving is working or is viable in the country. They did this here in the United States, and this is how they hooked me on a $99 a month subscription for full self-driving, as they offered me a free trial of the full self-driving, and I said, I kind of like this, and I've kept it ever since. Elon Musk rallied the troops in, I believe, kind of an impromptu, what they call all hands on deck. They streamed it on X last night, and I watched it, or I was listening to it. I was, playing with my kids, and I was listening to it and kind of watching to it as well. The company is selling this idea of building, quote, sustainable abundance. It's a slight pivot to what Tesla sold in the past, which I think was sustainable energy for the world, I think was kind of the mission. Now they're trying to shift things a little bit to sustainable abundance, which is a little more opaque, I think, from an investor standpoint, but certainly a big market as well. Elon obviously talked up the full self-driving cars, which are approaching approval here in California, which we'll talk about here in a minute. Talked about the energy and storage business, which I think when this company reports their earnings, probably in several weeks or maybe a month or so, the energy and storage business will absolutely be the fastest from a revenue perspective. And I think it actually might be the most profitable, as the cars have just obviously not been selling as well, been a little bit more promotional on the car side, and just in general, not just related to Tesla. The car business really, really sucks right now. Now, they talked about Optimus as well. Elon Musk was in absolute full hype mode as it relates to this, saying things like this is going to be $1 trillion product. It'll be bigger than any product in the history of the world. I mean, he literally says this to a 99% investor that like offends them. And they get a bad taste in their mouth. I don't mind. Like, I don't mind a CEO like pumping his book. Like, I don't mind it at all. But as it relates to Optimus, there is a lot of competition coming in China. They've already got a lot of the manufacturing thing. You also got to look at the EVs, the electric vehicles that have been launched in China. The competition on the humanoid robot side is also going to look a lot like that. Inside of the country of China, you are going to have a tremendous amount of these humanoid robots that are going to be built and developed there. Now, will those be allowed to be export here in the United States? I don't know, but at the current time, in the current political climate, there's countries like Canada, Europe, and other parts of the world that actually would take a Chinese robot over one made by Tesla. Now, whether or not that continues, I don't know. Certainly the United States market is open for competition, but here's the thing about humanoid robots that not a lot of people are talking about at the current time. Depending on the political climate, and I'm not really talking Republican or Democrat here, I think this is an issue that is going to go to both sides of the market, but depending on who is in charge and who is leading the respective parties, because we're just a couple of years away where both parties, both major parties here in the United States are at a crossroads. There'll be parts of the Republican Party that want to move away from Trump, away from quote unquote MAGA, and then there'll be parts that say, well, no, MAGA got us here, got Trump elected twice, blah, blah, blah. We're going to stay on that movement and put up like a JD Vance or another quote MAGA candidate as it relates to the Democrats. Now, hang with me here. This is really important if you're going to invest in robotics here in the United States. On the Democrat side, you have kind of the progressive wing, or maybe what's considered maybe a more moderate 90s Democrat, if you will. Now, here's the thing. Depending on which way things go, they are going to potentially tax the crap out of these humanoid robots. So if a company like Amazon or a company like Tesla or any of these automobile makers, they want to start replacing union labor or labor, any labor in general. A Starbucks wants to start putting robotic machines on the line and replacing people. Well, there might be heavy taxes and regulation and license fees and all that type of stuff, as we've seen in autonomous vehicles. Autonomous vehicles are here. You can get in a car and it can drive you. We can argue whether or not it's safe or whatever, and some people will want to do it and some people won't. But the bottom line is that technology is here. The only thing holding it back is government. And so government has a high probability of holding back humanoid robots from mass adoption here in the United States because of labor unions, because of human labor, and those types of things. We'll see how that evolves, but that'll be a major discussion going forward. The company recalled thousands of Cybertruck over exterior panel issues. This, I believe, is a, quote, real recall. Oftentimes with Tesla, these recalls are just a software fix, and with Wi-Fi in like 10 minutes, whatever was recalled is solved. This is actually, I believe, like a real recall where these vehicles will have to come back to service for Tesla. They'll change how they're attached or put some more glue on it. I don't know how that works, but this is like a real recall that will cost the company not significant amount of money, but some money. Company secured key transportation permits in California, taking steps for its first Robotaxi ambitions. Now, just so you're clear on how this is going to roll out for Tesla, is a lot of investors are going to criticize these first, quote, Robotaxis that are going to go out on the roads here in California will have human drivers in them. And so there'll be people in the media, some of you even in the comments, some of you watching this, you're going to be like, well, ha ha ha, Elon Musk was wrong. He can't even operate these full self-driving things without a human. That's not the case. Again, understand that the software and the cars are capable of driving themselves. The only thing holding them back are humans. Regulation. So California, I don't write the laws here in California. I don't vote for most of the people that actually get elected here in California. They've decided that in order to launch these vehicles into service, they need to be very thoroughly tested, which is fine. They need to be thoroughly tested and in a lot of cases have a human involved in the interactions in the early stages. Then once certain things are proved or enough politicians get money, then these things get wider approval. Now, in an odd moment, Howard Lutnick, who is a commerce secretary under President Trump, I believe he personally recommended buying Tesla shares, which was very odd considering he actually works for the administration and his group Cantor Fitzgerald also upgraded it. This wasn't the case that Cantor Fitzgerald just upgraded Tesla and that it's connected to Howard Lutnick. I think actually Howard himself said this. And so I'm sure he was told, maybe you shouldn't do that considering you work for President Trump now. Now, moving over to the technical segment of the show. Everybody always says that they're going to buy the dip until the dip actually shows up. And so we have a dip, but again, this is why you want to have technical chart patterns at least in your back pocket as an investor, because they provide a sense of comfort. The S&P 500 has pulled back. Yes, it is still on trend. We've just confirmed a new higher high. If you want to stretch this out to a much longer time frame, you cannot see the dip that I just posted on the chart. And those of you that are old men like me, remember this dip from 2000 to 2002. You remember very vividly this dip from 07 to 09. These are dips. And a lot of you even remember the dip in 2020 that lasted for about 2 weeks. These are actual dips. And even the dip from the peaks of 2022 to the start of the rate hikes and kind of the end of the COVID era, if you will, that was a pretty big dip as well. We're still not even close to that. Now, if this thing continues to move lower, then it creates some more interesting opportunities. But when the dips show up, the real men and the real investors show up, men and women. We've got a diverse audience here on the investor channel. The real men and women show up and know what to do. Speaking of knowing what to do, I'm a simple man. Meta's in an uptrend. Meta pulled back to the middle of the trend. I've been accumulating Meta. Very easy thing to see there. Apple has been in an uptrend for 5 years. When it pulls back, it has been a buy for 5 years. When it has pulled back over the past 30 years, it has been a buy. And so that is what I've been doing with Apple. Amazon, I was doing some charts or something with Amazon, so I don't have my trend on here. It obviously has in a much longer term trend. Amazon's slightly more volatile than the rest of these stocks, but the valuation has been pulled back and the e-commerce growth, profitability, AWS is kind of caught up to the valuation. So I've put a green box on this one. I think you can actually start buying it here in the 180s, 190s. Further pullback should be more aggressively bought. You should have a lot of consolidation that keeps it in that area. Now, one thing that I talked about earlier with Netflix is this one was actually the first to bottom in June of 2022. Most of these other stocks, like if we go back to Amazon, like this stock didn't bottom until January of 2023. And you really didn't see that this was in an uptrend really until like the middle springtime of 2023. Netflix was first into the drop, but actually first out. By 2023, this stock was locked in an uptrend. And so when this stock pulled back, I don't really like streaming stocks. I don't even watch Netflix, but it pulled back. It was a buy down here in the 840s, 850s. We're back up here in the 960s. You're looking for a move to the higher highs. If Netflix does that, then the rest of these stocks are going to get dragged right along with it. Don't want to skip Nvidia. Shares of Nvidia have been consolidating sideways for about a year now, between 103 up to about 152. You're towards the low end of that. This little purple line is nothing. But a lot of AI has been baked into the share price. I mean, obviously you go from $12 back in 2022 up to like 140, 150. A lot of good news has already been priced in this stock. So people are waiting for that next wave. Is it robotics? Is it just more continuation of the AI? Jensen Huang said, oh, like we've got $1 trillion. He said, we have $1 trillion a year in significant data center spend coming. And so if he's accurate about that, then that stock's going way higher. Google also, I'm a very simple man, people. Higher high back here in 2020. And we're looking at a short time frame. Like 3 or 4 years is a very short time frame. I know I do this show every week, and it's kind of designed to be kind of a weekly view at things, but when you start to pull back like this, you take a step back, and you made a high here in 2021. You made a new higher high in 2024. You've just more recently made a new high in 2025. You are confirming higher highs on this one. As you pull back, and Google should be very obvious what you should be doing there. Microsoft is pulled back to a decade-long trend, which is represented by this purple line. We have a green box on this one. That one also in an area where you are stepping in and buying it. Tesla's in a more unique situation. We've constantly said this here on the channel. It's a far more volatile stock. It also, as you can see over its history, obviously the history of the company is more or less straight up, but it's actually had this history of going straight up and then going sideways. It did that between 2014 all the way to 2019. For a 5-year period, Tesla basically went sideways. It was developing new models and trying to launch things. Company is basically in the same position. They're trying to launch new products and those types of things. And if you believe that the company is going to be able to pull off some kind of robot, some type of full self-driving robotaxi, which I think there is just enough evidence that Tesla is going to be able to pull it off. Well, you're probably consolidating sideways and waiting for the next push higher. Now, one thing that does get larger and larger, obviously, with Tesla is the market cap, $800 billion to $1 trillion market cap. And so the impact of the next product has to be big. So when we talk about robotics, we do have to talk about China and competition there. When we talk about robotaxis, we have to talk about Uber to a lesser degree, but more to a degree, Amazon and Google have big investments there. And so this company is going to be not going up against the sleepy old grandpas like Ford and GM and Toyota and Honda. They're going up against the big boys. This is a big boy arena that they're entering into as it relates to humanoid robots and with autonomous vehicles, but company has a lot of advantages there. They have a lot of opportunity there. And if they are able to pull it off, this is a buying opportunity. It's not like the smoking hot buying opportunity, but anywhere in this range, probably between 170 and about where the stock is right now, can be viewed as one if you don't have Elon derangement syndrome like many of you do. Hopefully you guys enjoyed today's video. Be back again with more. I was completely sick this week and I thought I had to condense the show. Instead, it turned into like a 45-minute affair. Hope that doesn't offend anybody. And if it did, I don't care. We'll see you again next week. Good luck with your investments.